Matthew's here with the business then. He's following big bags of cash being moved around EU corridors because Greece, they're finally going to get their money.
Yes, 130 billion euros of money is what they are desperate to get their hands on. Last week we had this successful bond swap deal where, a big proportion of investors said they would accept a cut of about 75% in the value of their bonds. This week, governments and parliaments have been ratifying that deal so the money can start to flow. The last piece of the jigsaw will be today when the IMF meets to confirm that it's happy for its 28 billion euro portion of the programme to go to Greece.
So do we know exactly what they're actually going to do with this money?
Well, they're not going to get this whole 130 billion euros in one go. They're going to get it in tranches. There's a big tranche of about 39 billion euros, which will go first. Now, a lot of that actually is going to be needed to help the Greek banks because Greek banks were part of the deal on the bond swap, so they will need a bit of recapitalising just to make sure that they're in good shape for the future.
And a renewed focus as well on Portugal.
Yes, so Portugal as well has had a bailout, a smaller bailout, 78 billion euros. Now, of course, understandably, the EU is very keen not to see the same kind of drama playing out there that it's had in Greece. The Monetary Affairs Commissioner from the EU, Olli Rehn, has been in Lisbon this week. He was explaining how Portugal is not the same as Greece. It's very different. Let's take a look.
First of all, the debt burden is not at all in the same scale, same magnitude. Second, there is a strong and broad political consensus backing the program from the start, and this has meant that the implementation of the program has been on track in the past year, and I trust that it will remain on track also in the future.
Let's look at the markets. They've been pretty good this week. Is that continuing?
Yeah, it's been pretty good. I mean, there's a bit of a mixed picture this morning. We can start by taking a look at Europe, where markets have just opened up this morning. There we can see bit of red, bit of green there in Frankfurt. So mixed picture. We'll see how that plays out. Over in Asia, we can now look at how things wrapped up. We saw the Nikkei finishing in very positive territory. Very weak yen, very weak against the dollar. That's helping exporters. So good sentiment there. Whereas over in China, we can see the Shanghai Composite was down. The Premier Wen Jiabao was making comments about the real estate market, saying it's still too high. That dampened hopes of further monetary easing. That then dampened sentiment on the markets there. I was just going to mention as well, do you remember how we used to talk about Italy bond sales all the time? And
yes,
Italy was back in the market yesterday. Now, there was when we were very concerned when it was around 7% the yield on their bonds. Now, what's been happening since then, and we haven't been talking so much, is that it's actually been falling and doing quite well. So that's a piece of good news there about how things seem to be going in Italy.
OK, well, on Tuesday, Hungary was told it would not get 500 million euros of much-needed funds unless it gets its budget deficit under 3%. The Prime Minister, Viktor Orban, is also in dispute with the EU and the IMF over a new constitution. So how is the country coping with all its financial problems? This report from our correspondent, Gulliver Cragg.
Budapest's trams are creaking under the weight of debt. The city can't afford the tens of millions of euros owed by its transport company, a situation that some say could push the whole country under.
If the largest municipality of a country is in bankruptcy and the state has no money to save it, then the state is in bankruptcy.
For now, the state has guaranteed an extension on the loans, but there's no long-term solution in sight. Metro passengers had mixed views about their government's economic competence.
The main problem is that they just don't know what they're doing. They're doing even the opposite of what they promised.
I fully support the government and its decision to tax multinationals and also banks very heavily.
Big taxes on big firms and banks brought Hungary's deficit within the EU limit of 3% of GDP last year. But as those measures were temporary, the EU says they don't count. Hence the suspension of European Cohesion Fund payments to Budapest. Yet as the Organisation for Economic Cooperation and Development presented its own critical report on Hungary's economy, Junior Minister Zoltán Cefalvai shrugged off the problems.
The Hungarian government is committed and determined to keep the budget deficit below 3% in this year and also the next year.
In presenting the report, the OECD's Andrew Dean said himself he felt it was like spitting into the wind, though he did strive to sound a note of optimism.
The wind can sometimes change, and things change, governments change, They may adopt policies which initially they thought wouldn't be that useful.
The OECD recommends that Hungary secure a credit line from the IMF and EU as soon as possible. But so far, the government has not even met the conditions to start talks. Perhaps it feels the country can stay afloat without assistance. Many economists disagree.
Kind of a crank there in Hungary. Let's pick up on a few more of the day's business stories. And a 20-year-old trade war between the EU, the US and Canada over beef has finally been settled. A row over growth hormones used on North American cattle ranches sparked the ban in 1988. Now, the new agreement will set an annual quota for the import of beef that hasn't been treated with the hormones. In return, the US and Canada will lift import tariffs on a range of European goods, including chocolate, cheese and jam.
Credit ratings agency Fitch has lowered its outlook for the UK. While Britain will keep its AAA credit rating for now, the agency said the outlook has gone from stable to negative. Fitch said the UK is limited in its ability to absorb any further economic shocks stemming from the European economic crisis.
And the chief executive of Tesco's UK operations, Richard Brasher, is stepping down. According to the Financial Times, the country's biggest retailer has been battling to improve its performance in its home market. After the first profit warning in 20 years, Brasher reported to have clashed with Group Chief Executive Philip Clark, in particular over a £500 million price-cutting programme.
Now, the diamond industry is a key source of tax revenue for Zimbabwe, but the country is struggling with lower than expected tax receipts. Zimbabwe's finance minister has said the government faces a virtual shutdown unless the situation improves. This story from Luke Schrago.
Zimbabwe's finance minister left no room for doubt. Paying out national wages isn't leaving enough in the treasury for the government to function.
Out of every dollar that we are collecting, only 30 cents is going to other obligations on the government. So diamonds have to deliver. Otherwise, the only thing we'll be able to do is just to pay wages, and which means that government will virtually close down.
Zimbabwe had predicted profits of $77.5 million from diamond sales over the last 2 months. However, there's been no auction of the precious stones, and the unity government, split between President Robert Mugabe's ZANU-PF and Morgan Tsvangirai's Movement for Democratic Change, has netted just $19.5 million. Zimbabwe's already seen a decade of serious decline, and unemployment's running at 80%, strangling the national tax base. The nation's economy has seen a tentative recovery in the wake of 2008's violence-struck election, but there's a long way to go yet, especially if funding's to be found for a general election Mugabe wants later this year.
Yeah, that report on Zimbabwe. That's it from us. Thanks, Matthew. Matthew here with the business. Of course, he'll be back tomorrow, and Claire's got the latest news after the break. Stay with us.